Hey, good day, good day, good day. It's Ronco Johnson, your lifestyle focused wealth coach. How are you? It's Lifestyle Focused Friday, and you're watching When the Lights Go Out. Are you ready? Good to see you, good to see you, good to see you. Are you ready to transform your retirement? Are you ready? We're going to be talking about some of my retirement secrets revealed to you, all the way from annuities to tax free income. You don't want to miss what's going on today. We're gonna unlock some treasures that's gonna keep you informed and can transform your retirement planning right away. So sit back, relax, and unwind as we dive into this opportunity of a lifetime. Why? Because you're gonna need the help. And why rolling over your 401k to these types of annuities might be a smart move, and why using life insurance can also help. And it's a critical role before 72 and a half years old. But we're going to unlock it. We're going to discover it. We're going to tell you the things that they're not telling you in the hopes that we help you on the long run. So come back here and learn how these loans from insurance policies also can provide you tax-free retirement income and explore why our lifestyle-focused wealth philosophy integrated with your lifestyle may work just fine for you. Hey, I'm Ronco Johnson. Thank you for joining us, and I look forward to seeing you on the inside. See you there. Hey, what's up, everybody? I'm Ronco Johnson, your lifestyle-focused wealth coach. Good to see you. Another Friday, another Friday. It's almost Easter time, so depending on where you're watching this, happy Easter in advance to you. Happy Easter in advance to you and your family. Hey, thank you for joining us again. We're going to be talking about some different things today. We're going to be talking about, oh man, I'm going to give away some secrets to put in your Easter egg basket, some money. The money egg is in the house today. So if you want the money egg, you're just going to have to come out here and find it. Tell your family and friends you're hanging out with us. And, show us some love. Show us some love. I see some folks out there coming in our office. And what's happening, Leela? I see you out there. Miss Henderson. Hey, Mr. Johnson, what's going on? I see you guys over there really early today. Thank you for joining us. Man, can you believe it's time to put eggs in your Easter egg basket? But how valuable are those eggs today? How costly are those eggs? I was watching a program the other day on television, and they were talking about the cost of eggs has caused people to start using other products instead of eggs, like potatoes, mushrooms. I'm sorry. What else? What else? Marshmallows. Oh, the differences. Why can't things just be simple? Why can't we just go back to just finding eggs in the house? Or better yet, the plastic egg, that way you didn't lose one and have a spoiled egg in your house forever and ever. Amen. If you remember that, give me a thumbs up in the chat. If you remember those days, give me a thumbs up in the chat. That's back when we used to go outside, folks. For all you younger than millennials out there, that's when we used to go outside and actually look for eggs instead of playing video games and having good times with your cousins and all the good stuff. Family was a little bit different them days. Man, I tell you, I miss them. Nostalgic. But listen, today we're here to talk about how some of my greatest secrets work well for you. And, I go back and forth. Some days, I don't know if I want to tell too much, because I don't want to burn the internet up too hot. But when certain economies are like they are, and we're getting so many calls offline, I know that some of you really, really need our help. So what we're going to do is we're going to talk about some of the things that concern you. And hopefully by the end of this message, you're clear. Or you've signed up to have us have a one-on-one with you to help clarify your personal situation. I think that's important that I say at the very beginning. Your personal situation is not like everybody else's. So we don't do cookie cutter plans, but today's information is to give you some financial education, some literacy, so that it can make a little bit more sense on what you should do, what you should consider, and who you can call. Okay? Is that fair? Is that fair? Do me a favor, say that's fair in the comments. Oh, tell me that's fair in the comments. I need you to do a couple things before we get started, if you don't mind. If you don't mind, I really, really look forward to you guys recommending our program. And I need you to do this before we get started. Hit the thumbs up button on your YouTube channel. Hit the share button on your channel. And most importantly, hit the subscribe button on your channel. And then share it with your family and friends. Don't keep us a secret. Don't keep us a secret. A lot of people need our information. And we want to be here to help you. We want to be here to give you all the insight that you can have, right? That's what's hot. That is what's hot today. So what's happened in the past week? And man, I tell you, it's been an interesting ride here. It's been an interesting ride. You know, everything that's going on in the White House and how it's affecting you has gotten us to this point, right? Yes, go ahead. For those of you looking, go ahead and start sharing right now. Go ahead and start sharing. For those of you that are listening, that have friends that might want to hear this, if you've been laid off in the last 90 days, 60 days, 5 days, this is the conversation for you. If you have been laid off, this is a conversation for you. But you better do it quickly, because this information that I'm about to give, not everybody provides it. And you're going to have to act on it pretty quickly. Why? Because it affects your entire retirement, right? We're going to talk about why these strategies can transform your retirement planning. And we're going to dive into it. Why rolling over your 401k to these equity index annuities could be a smart move for you. And why it's critical that you understand why 72 and a half is a critical age and the role it plays in your IRA or your 401k. You need to know these things. We're going to discover a much more innovative approach that I love, that transfers tax-free dollars or after-tax dollars from an IRA to a non-qualified plan or into cash value life insurance for long-term. So today you're going to learn how these loans and life insurance or whole life insurance can provide a tax-free retirement for you. And then we're going to explore why our lifestyle-focused wealth philosophy might be a good fit for you. So thank you for tuning in and making this your home. I'm looking forward to talking to you today. Man, thank you guys for the love. I really appreciate the love. I really appreciate the love. You know, last week I got a lot of calls afterward, and people were like, RJ, I like the way that you gave that particular information and in a real world scenario. So we're trying to do it a little different today. And I really appreciate you and your conversation. And you know what we try to do? We really try to accommodate everybody that's listening. Why? Because we need you in the room. Simple as that. We need you in the room. And if you're successful, we're successful. And the more successful you're going to be, the more successful the ones around you will be. And you will continue to talk about all the goodwill that we're spreading around here, right? So if you wouldn't mind, at the end of the show, don't forget to go down to the description area and get registered, right? Get registered. Get onto our bi-weekly email list so you can get the articles that we put out, the travel articles, the recipes, and much, much more. It's absolutely free just for you being a part of our Lifestyle Focused Wealth community. And we want you to be a part of that. We think everybody needs to be a part of that, right? I do. I believe it. So join us online. Go to Lifestyle Focused Wealth community, and you can start joining our Lifestyle Focused Wealth community as low as $16 a month. All you got to do is go to roncojohnson.com or lifestylefocusedwealthcommunity.com. Get signed up. It's pretty quick. It's fun. It allows you to be a part of a group of people that are already taking advantage of what millionaires and billionaires do. That's exactly what we're doing here. So, without further ado, we're going to jump right into it. Are y'all ready to get started? Are y'all ready to get started? What are your plans for the Easter holiday? Man, well, let's set this up first. Some of the things that will be discussed this year over the holiday, I'm sure one of the hottest topics was going to be my retirement plan and how it affects you. You know, thousands of federal employees have been let go. CDC workers have been let go. Nonprofit organizations have been let go. All at the same time. Why is this a concern for people like myself or people that are in the money business, in the financial business? Because we understand its impact. Let me set this up for you. For those of you who may not understand completely, you know, when those federal employees were working and all of a sudden they're not, they had these jobs for 20, sometimes 30 years. They've built up this retirement plan because they've trusted the retirement plan at work as their retirement plan. And that is not true. It's a retirement account, but it is not a plan. And I'm hoping that you guys understand that today. It's not a plan. Okay? It's not. It's just an account. But it goes even further than that for me. Is you got to think about the one individual who thought that it's okay to crush your retirement plans for his personal benefit. It's overwhelmingly sickening. And that's why I'm giving this podcast today. That's why we're here today. You know, sometimes we got to share the secrets. Sometimes we got to share the secrets. And the secrets that we want to share today is because we want to help someone. We want to dig someone out of a hole who thinks they're hopeless right now. And for a lot of you, you're running scared. It's meant to be that way. All confusion meant to get you nervous, meant to make you make decisions that probably are not in your best interest. And many people mess this up. They just do. You know, like maybe they got a bill to be paid. Maybe they got a mortgage to pay. Maybe college tuition is due. And the first thing they do when they get laid off is ask for all their money out. And because they got more money than they've ever had before at one time in their checking account, the intent was to be safe. But what happens is you end up buying new cars. You end up doing things that you're not supposed to do. Maybe you put some new kitchen cabinets down. Maybe you bought some tires or some rims for your vehicle. That's not what these retirement funds are for, people. That's not what it's for. If you can just stick to it, mentally stay tough, then we're going to talk to you about some opportunities that may benefit you, right? We're going to talk about those. And the whole goal is to help you understand that, this is not the end of the world. We just got to get to the other side. You can't go over it, can't go under it, but you got to go through it. You know that? You got to go through it. So here's 5 reasons why you should consider rolling over your 401k to an IRA funded by an indexed annuity. And I'm going to give them to you. Is that all right with you? Is that all right with you? So get your pens and paper ready. Get your pens and paper ready. Here we go. So when we talk about rolling over your 401k to an annuity of any kind, we're not talking about all the annuities. We're really just talking about one. I'm talking about the indexed annuity, the one annuity that gives a couple of different safeguards that I like to use that can offer several benefits depending on what your financial goals are and your circumstances. Here's 5 reasons that may be a good idea for you to consider. Number 1, you got guaranteed lifetime income. Guaranteed lifetime income. Index annuities, see, they can provide a steady income stream for life, ensuring you that they don't run out of money. See, insurance companies are really smart. They leverage on 2 different ways. They have a life insurance product, just in case you die too early, and then they have an annuity product that, just in case you live too long. Well, the annuity product is designed so that you won't outlive your savings. That's really what its design is all about. Number 2, protection for market fluctuations and losses. So unlike traditional investments like stocks, bonds, mutual funds, and even real estate, you're not worried about your money going up and down and just going away. Index annuities, what they do is they shield your principal from market downturns. And that makes it a lot more comfortable for those of you approaching retirement. And that if you're in the preservation stage of your life, this gives you comfort. This allows you to do some things with your money without worrying about looking at your spreadsheet. It allows you to grow money that's tied to the market when it's upside, but you're not going to experience the downside if it goes negative on you. Number 3, tax deferred growth. See, your funds continue to grow tax deferred, which means it's growing, but you don't have to pay any taxes on it yet. Similar to the 401k, which you can take advantage of for long-term savings. That makes things good because if you're not using the funds, you don't have to pay taxes on the money yet. Number 4, they have customizable features that, depending on who you go to and who you sit with, and depending on what your lifestyle looks like, we can design these things in multiple different ways. So many index annuities offer options like inflation protection or spousal benefits. And they also allow you to tailor it so that you can tailor it based on the plan that you need. It's not a cookie cutter type of plan. Maybe you want income sometime down the road, a little bit earlier than normal. Who knows? But you can do these different things. You need to know that these options are available to you. Am I making sense? So, number 5, simplify retirement planning. I'm talking about make this thing simple. Let's not go out here running around being chaotic. Grab somebody by the hair and say, or by the jacket or by the shirt and say, listen, don't do that. Do this. This is what wealthy people do. This is where we got to go. Yes, we're no longer working there anymore, but we got to still maintain. We got to keep calm and make a better decision. Simplified retirement planning means this: consolidating your retirement savings into an index annuity. It can make things easier to manage. And that's why most retirees have them, because it's all in one place. The plan for your future, right? So, however, it's important to weigh these benefits that I've just talked about against the drawbacks, such as fees and reduced liquidity, meaning you can't just go into it and grab it, because if you do, those funds have not been taxed yet. So they still have to have federal taxes, state taxes, and then if you're younger than 59 and a half, the government has a 59 and a half penalty there. But the insurance company also has a surrender charge. That's usually between 10 years, maybe 15, depending on the company. But most of the time, you'll see a 10-year charge. And that's just to keep a person from going out and blowing their money, right? And just blowing their money. But that is the only charge from the insurance company. It's a 10% surrender charge. However, most of these contracts have a surrender-free withdrawal, which will allow you the opportunity to have access to your money and the first 10% without any surrender charge. But you can have more access to the rest of your money, but you would have to pay that 10% surrender charge, anything over 10%. Okay? Hopefully I didn't give you the double Dutch rope conversation right there, but if it made sense, please give me a thumbs up. Continue to talk to me, ask your questions. Y'all, please put your questions down and be sure to let me know, if I say something that triggers an idea, okay? Today's the day. Today is the day that you wanna let me know, okay? Because this is all about you. This is all about helping you get your roadmap where we need to go. And this is some opportunities for you to gather some information that's not costing you a grip right now, right? All you have to do is just listen. All you have to do is listen. And then, I know some of you like to check me out and check us out. Go right ahead. We're 28 years in the business of insurance and financial services. We're amongst the top less than 1% in the world of what we do, recognized by the $1 Million Roundtable. And I can tell you that our biggest concern is making sure you get where you got to go, right? We want to make sure you get where you got to go. So the next part of our conversation today, we're going to talk to you about this. This is another hidden secret that a lot of people just miss. Okay? Did you know there's only a few years, I think it's 13 years, that you don't have to worry about penalties? Between age 19 and 57-ish, that you don't have to worry about penalties, right? You got penalties if you take money out before 59 and a half. But after 59 and a half, then what? There's no penalties, right? Not necessarily true. Why is it that age 72 and a half is important to your IRA or your 401k? For those of you that are working, that are in your 70s, here's some important information for you to know. At age 72 and a half, it's significant when it comes to your IRA or your 401k, because it marks the age when you are required to take what is called a required minimum distribution. And these are mandatory withdrawals from your retirement accounts per the IRS rules. So this is why it matters. I'm going to give you a few reasons why it matters. 3 big reasons why it matters, and please pay attention. The tax implications are huge. The money you withdraw is considered taxable income. This impacts your overall tax situation. So in other words, if you're already making, say, $75,000, $80,000 a year of income, and then you start to take out another $10,000, $20,000, $30,000 out of your 401k or IRA, all of that now is considered income. And what that has done is driven your marginal tax bracket even higher. If you're in California or one of these higher states with higher federal taxes, please pay attention to that. You might not be getting out enough money. So that means you may have to pay more taxes to net what you really need to get by. So you got to be careful. Number 2, avoiding penalties. If you fail to take your RMD or your required minimum distribution, you could face a very hefty penalty. And that penalty is up to 50% of the amount not withdrawn. I said it right. Up to 50% of the amount not withdrawn. So, wait a minute. You mean after 59 and a half, I got another penalty? Yes, it starts at 72 and a half. So, there's a time period in here, folks, as I'm leaning to. For those folks who have been sitting on their IRAs forever and ever, amen. That's probably not the best thing to do, because the IRS is coming to get THEIRS, theirs. And they're just waiting until 72 and a half. So, number 3, planning your planning considerations. Your RMDs can affect your financial planning in many ways, especially if you're trying to manage your tax bracket and preserve your savings. Again, when you take this money out, it hasn't been taxed. Therefore, it could increase your tax bracket much higher than you want. And these RMDs may not be dollars that you won't even touch because you don't need it right now. But because there's a requirement to it, it's forcing you to be taxed on money you didn't even need right now. But hold on, I got a solution for you. Are you guys following where I am? Are you guys following where we are today? Because have a conversation back with me. Yeah, I see some people are already showing their frustration. Well, no worries, because this is where we're going to help you out. This is where we're going to help you out. See, you guys have something that everyone else doesn't have. You have access to our lifestyle-focused wealth community, and this is why it's so important. Okay, this is why it's so important. And after the break here, I'm going to take a small break, and then we'll come back and we're going to talk about, opportunities that can take your income from an IRA and transfer the after-tax dollars to non-qualified products and services, and why it may be a good strategy for you. So having this opportunity to talk to someone like us might be just the little advantage that you really, really needed, and that you can share with other people so that they're not harmed by the effect of thinking they only have one move on a chessboard. They have multiple moves, but usually you have to go sit down with an expert to figure it out. Sit back, relax, and unwind. I'll be right back. Hey, join our lifestyle-focused wealth community. Membership starting at $16 a month when you pay the annual subscription. So register online today at www.lifestylefocusedwealth.com. Hey, thank you guys for joining us. This is Lifestyle Focused Wealth. Happy Friday. It's Lifestyle Focused Friday. Man, just before the Easter holidays. So I decided I was going to drop some financial Easter eggs on your head, and hopefully you catch it. And hopefully you catch it because while you're sitting there at dinner with your loved ones, your cousins, your uncles, your aunts, somebody you know has been affected. And I want you to make sure that you have an answer for them or at least a recommendation for them. And that recommendation is contact us here. Go to roncojohnson.com. It's easy to get on our calendar. It's available to you 24 hours a day. Just go to roncojohnson.com, click on section 2, select number 2, and schedule some time to do a one-on-one with us. For me, you, your family, maybe we can all get on and answer multiple questions for you. And hopefully we're helping you get where you want to go. But after last week's meeting, I had some people contact me and were interested in my strategies and some of the things that we had done for them. And they said to me that maybe I need to share some of that on the show. I thought about it and I said, well, it would impact people, but we all have secrets to our sauce, right? We do all have secrets to our sauce. But when you can justify why we do certain things, I think it makes it easier for you, the consumer, to understand and then to feel comfortable about coming to sit down with someone like our team and having the discussion, right? Hey, I see a lot of you hanging out with me today, man. Look, I love it. I love it. I love it. Thank you guys for joining us today. If this is your first time in, thank you guys for hanging out with us. We're just talking about the simple things what millionaires and billionaires do. But today we're talking about the common folks out here who have retirement plans. And what should I do with them? Do I roll them over? Do I leave it there? Do I take all the taxes out? Should I buy a car or a house? No, you shouldn't do any of those things. You shouldn't. You shouldn't. Let's talk about how taking income from an IRA, listen closely what I'm saying, because I don't want somebody out there to do the wrong thing. Taking income from an IRA and then transferring it to what we call non-qualified index annuities. I didn't say Roth IRA. I said non-qualified index annuity. One, because unlike the Roth IRA, there's not limits to it. And that limit is so small that most people are not going to reach their retirement goals. But at least with the non-qualified index annuity, using this in your strategy, you have much more money that you can put away. Actually, there's no limit. So if you're going to use this strategy, this is one of the ways that we avoid the 72.5 required minimum distribution. Because in the non-qualified environment or the after-tax environment, Uncle Sam feels like you've already paid your taxes. So you don't owe us anything else until you have money earned. And any money earned, you would have to pay taxes at that time on the earnings, not on the principal. Does that make sense? So now, this particular time, we're going to talk about transferring after-tax dollars from an IRA to a non-qualified annuity and why it's a viable long-term strategy. Again, this all depends on what your financial goals are, but here's the potential benefits that I think that you can benefit from. And here's 5 of them. Number 1, tax-deferred growth. It's always tax-deferred growth for me, right? Non-qualified annuities allow your money to grow tax-deferred, which means you won't pay taxes on earnings until you withdraw them. That's right. If it stays there for years and years and years, you don't have to pay any taxes on it until you withdraw those earnings, okay? Number 2, income stream. The index annuities can provide an income stream, which particularly is useful in retirement planning. Maybe you have an annuity that you've had in its deferred state for a moment, maybe up until a certain age. Maybe you need a little bit of income between waiting for Social Security. It might not be a bad time to turn the income stream spigot on and allow your annuities to start paying you an income on a monthly basis or annual basis, 5 years, 10 years, 30 years, or for life. You have the opportunity to do these. You just got to know where to go. Number three, principal protection. See, these annuities are often have features that protect your principal. And we all want to be protected from market losses. Have you seen the market today? Just yesterday, last week, we're below 2020 market prices. Yes, there may be opportunities. However, if today was your retirement day, you are struggling. You've lost a significant amount of money. And as I've talked about the people who are near retirement or in retirement, who happen to lose their jobs right at this time, and then the market crashes right behind it, they don't have the opportunity to gain that money back because they're no longer with the employer and they can't continue to fund it. It's a sad, sad time. Sad, sad scene, right? So having something like this type of annuity would work in this circumstance because we're not worried about the downside in the marketplace. Number four, flexibility. See, non-qualified means after tax. Non-qualified annuities don't have contribution limits. So that means it's allowing you to invest more than the annual limits for tax advantaged accounts. That's much more than those things called Roth IRAs. You can put more money into them. Let's keep it very simple. I don't want to talk over your head, right? Sometimes these things are over your head or you feel like they are, but all we needed was someone just to give us some layman's terms to help us feel better, right? Number five, for the fifth reason, estate planning, it works. See, they can offer benefits for estate planning, such as passing on your assets to a beneficiary. Having these annuities in place, they're beneficial in this way. However, we want to keep in mind that there's a tax implication. Yes, taxes, while your original contribution is not taxed again, the earning portion, just the earning portion of withdrawals is taxed as ordinary income. So in other words, if I've already rolled over some money and I've paid taxes on my first $100,000, I don't have to pay tax on that 100 ever again. But if it goes from 100 to 125, I owe taxes on the 25 because that's earnings. If that makes sense, give me a thumbs up and let me know that we're explaining that properly so that everybody here is looking at it and can hear it. And if you got more comments, keep putting them in the comments. I'm reading them. I just want to make sure we're getting all this information out there for you today. And please put takeaways. If we're saying some nuggets for you or some Easter eggs for you, let me know. Let me know we're giving you some nuggets today. These things are important to me. It's important to all of us, actually. So number two thing to keep in mind, liquidity. Non-qualified annuities, they may have a surrender charge. As I talked to you about before, insurance companies have surrender charges, or they're called penalties for early withdrawal. So they don't want you to necessarily touch these types of annuities, but a lot of people get this thing wrong. They think they can't touch their money at all. No, that is not true. You have access to your money. It's just that you're going to have to pay a charge for it. That's 10% surrender charge for what you're going to pull out that you're not putting back in. But over a 10-year period of time, that surrender charge, it reduces 1% or 0.5% every year until it reaches year 11 and it's zero. And once it gets to zero, you don't have to worry about the surrender charge again. Number three, fees. Fees on index annuities can come with fees and it can impact your overall returns. right? Well, let's talk about those fees. When you sit down with your advisor, one of the things that we look at is what are the fees and how you can avoid some of these fees. Many of these retirement accounts or many of these annuities have a 10% surrender-free withdrawal, which means you have access to 10% of your money without a surrender charge. So if you have $100,000, you have access to the first $10,000 without paying a surrender charge. Now, you still have to pay state and federal taxes. And if you're before 59 and a half, you would still have to pay the 59 and a half if that was what it was. But if I'm withdrawing from a non-qualified, I've already paid my state. I've already paid my federal. So, and I don't have to worry about the 59 and a half rule at that point, right? Am I making sense? If I'm making sense, give me some comments. You can put this comments down in the comments. Let me know. Let me know. Because I'm breaking it down for you today. And just because you asked me, and this came from, seriously, folks, this came from people wanting to really know. And we had a group conversation with some ladies that were having a conversation about starting a business. And because they watch our program, they simply asked me to dig into this scenario. And I decided to do so. So you never know. I get to read it. I read it. I talk to you about it. And then on top of it, we'll come back and give you some answers. And it's not meant to be advice. It's just meant to say, look, here are some options for you, right? If you like to explore very specific scenarios or compare a strategy or two, hey, give me a call. Let us know. Maybe we can put it on the show and share it with everybody. So number two is the second part to this that I really enjoy is, here's another question. Can we take the income from an IRA and transfer the after-tax dollars to cash value whole life insurance? Is this a good strategy for long term? Transferring after-tax dollars from an IRA to cash value whole life insurance can be a very strategic move, but it depends on your financial goals and circumstances. But I'm going to tell you some of the benefits that I enjoy when we put these together for folks. And here's some of the potential benefits. There's 5 of them. Once again, tax advantaged growth. Cash value life insurance also grows tax deferred, meaning the money continues to grow inside of it without taxes, which can be advantageous for your long-term savings. So number 2, estate planning. Whole life insurance provides a death benefit. Unlike the annuity, life insurance has a death benefit that can be passed on to your beneficiaries, tax-free, making it a very useful tool for legacy planning. Number 3, access to cash value. The one thing I really love about cash value life insurance policies is that you have the opportunity to borrow against the cash value or withdraw your funds. This offering makes it flexible in managing your finances. But let's talk about the two, borrowing funds and withdrawing funds. Well, first of all, withdrawing funds means you have no intent on putting it back. So be careful with that. You could trigger a taxable income at that point. However, if you've learned the value of borrowing against cash value, taking a loan against your cash value, then you understand that you're not borrowing your money, you're borrowing the insurance company's money. That's correct. You're borrowing OPM, and it reduces your death benefit until you pay it back. When you pay it back, your death benefit goes right back up. That's the beauty of it. It allows your money to continue to grow compounded interest on a tax advantage basis while it's sitting there. That's the beauty. Number 4, diversification. I personally think it adds another layer of diversification to your financial portfolio Separating some assets that are more volatile actually gives some understanding and some safeguards to all the other things. If I personally, I like to use cash value insurance as the stability point. Why? Because I can borrow money from it, and then I can put those dollars in other things that are more volatile. And guess what? If the market were to shift in a negative, I'm still earning dividends and interest from my life insurance. But see, these are all tools that we want to use things together instead of using them individually. Individually, these things may not make sense to you. But once we put them together in a strategy, it works every time. Number 5, protection. Whole life protection ensures a guaranteed payout, regardless of market conditions. So we can knock all the BS and all the other stuff you heard on TikTok and the IULs and all the other stuff. The one thing I can tell you about the whole life product is it's got guarantees. Go ahead, I'll wait. If you can do any better than a guarantee, I'll wait. I like the guarantees in life, right? So that makes your retirement less difficult to manage because we know exactly where we're going. So these are some of the considerations that I keep in mind. Cost of life insurance, it can be expensive with high premiums compared to investment options. However, it really depends on what we're looking at. If you're using it in a banking concept, you're looking at the fact that you're chasing dividends. Yes, there's a cost to it. You got to pay to play. Folks, we can't stop. We can't get involved with things thinking we're going to get something for free. You just need to stop it. But if you start to really pay attention, the things that tend to cost more have a better long-term result. Liquidity. You have access to your cash value with, that may come with a restriction or two or some penalties. But in most cases, you can use cash value for whatever you want. And your returns, your rate of return, your growth rate on cash value or life insurance is typically lower than other investment vehicles. You know why? Because life insurance is not an investment. It's life insurance. The word premium means it gets tax advantages from our government. The word investment means it's taxable. Okay? Life insurance is not an investment. So we got to make sure that we're very clear about the things that we're saying. And once you hear it differently, then you understand that this is a different vehicle than all the other products that we've mentioned before. So if you would like to compare those and compare some different strategies, once again, I'm going to invite you to come on down and share it with us and talk to me about it and talk to us about it. And let me help you figure this thing out, right? Let me help you. Let me help you figure this thing out because, every once in a while we need expert guidance. If you don't have it, let's get some. We're right here for you. That's what we want to do. We want to be strategic. We're not trying to make your life miserable. We want to make sure that you're going to be around for a while and you can focus on your lifestyle. And these are ways that we've been able to do it without making a person go absolutely crazy like our government right now. So my whole goal is to lower some of your tensions, maybe out of the folks that are listening to our podcast, our broadcast right now. It starts with you. You could go off and talk to your family members. Maybe they got 401ks and IRAs that are sitting at their old jobs. Maybe they just got laid off. Maybe you know somebody that just received a large settlement. Those are people that need to have our direction. Those are people that we need to hear from. And if you're with them, I can promise you this. You've put them in the right place, but you're invited to come right along with them and learn what we do behind the scenes instead of the little bit of pieces of fragment. I got a question that came up in the comments. It says, "How do loans from whole life insurance provide potential tax-free retirement?" And I love this question. I love this question. See, the loans from whole life insurance can be strategic, a very strategic way to access these funds for retirement while you minimize your tax liabilities. And this is how it works. See, your tax-free access, number one, when you borrow against the cash value of whole life insurance policies, the loan is not considered taxable income. It is a loan. It is not income. This allows you to access the funds without triggering taxes. Yes, I may have to pay an interest rate, but that interest rate is going to be less than the income taxes on the same amount of money. So unlike withdrawals from traditional retirement accounts, where you're paying taxable marginal tax rates, you may be paying an interest rate of a loan. And those loans are calculated one time a year. So those are some advantages of using your life insurance. Number two, no repayment obligations. While you can repay your loan, it's not mandatory. We want to recommend that you do, but the loan amount and any accrued interest are deducted from the death benefit. You remember earlier I said that you're borrowing from the insurance company's reserves? Well, because it belongs to the insurance company, they're leveraging against the death benefit that you bought, ensuring flexibility in managing your finances. It's okay. That's all this is. So you do want to put back the money that you borrow, because in our banking scenario, we want to be a good banker. And when we put money back, we get to use it again. We put money back, we get to use it again. But also, depending on the way the policy is designed, it can definitely affect the continuous growth, which is number three. When you put money back in, you're only making your dividend bigger. So even while you borrow against your cash value, the remaining balance continues to grow tax deferred, preserving the policy's value. And I absolutely love it. I love when we're talking about it, because this needs to be more of a conversation piece, especially today, because most people are getting this information and don't understand why. Well, once you start to figure out that our United States government is a business and they're marketing how to generate revenue through taxes, okay, they're going to talk about IRAs, Roth IRAs, 401ks. They're going to make you feel like those are the best instruments for them to get revenue. But when you understand that these products are contractual products that are between you and the insurance company, then you start to figure out why it's not being marketed so much, why there's rules about how we speak about these products as well. All right? Because they're not benefiting from these products in terms of revenue. Guess who's benefiting? You are. So, number 4, estate planning. The death benefit remains intact, minus any loans, providing you a tax-free legacy. And that legacy goes to who? Your babies, your beneficiaries, your business partners. Man, it goes on and on and on. So however important it is to manage these loans, be careful. You want to avoid lapsing or excessive interest rates because you left it there too long. So we don't want to do that. So if you would like to explore this opportunity, let me know. Let me know. Why? Because it's a vital part of your retirement planning. Do we have any questions out there? How are we doing out there? Did I lose anybody today? Have I lost anybody? Man, I can see, man, I see you guys all popping up in there. Good deal. Thank you guys so much. I I get overjoyed when I see you guys are really participating and hearing. Because sometimes, when we're in the studio, we don't know if anybody's listening to us or not. We don't know. We have no idea if we're on it. If we're on it by ourselves, where are we going? Okay. I just got a question that came across. I got a question that came across, and I'm going to continue to tell you this. I encourage you to become part of our Lifestyle Focused Wealth group. We got a Facebook group. We do some things together. But what the question is how can I subscribe to your Lifestyle Focused Wealth philosophy? And what are the benefits of the strategies for retirement? Well, you can subscribe. You can go onto a YouTube channel and subscribe. Or you can just hit subscribe right here on YouTube and Facebook, or you can go to Ronco Johnson at Facebook or Ronco Johnson on LinkedIn, Ronco Johnson at YouTube, IG, TikTok. Join it. Join in. Okay, that's what we want. But how does the lifestyle benefit you and your retirement strategies in retirement? How does our lifestyle focused wealth philosophy benefit you? Well, I can tell you now, by subscribing to our lifestyle focused wealth philosophy, there are several benefits to your retirement. One, we talk about integrated wealth building principles. See, our philosophy emphasizes integrating wealth building strategies into your daily lifestyle, making financial planning a seamless part of your routine. It's kind of like your pocketbook. You got money in your pocket, so your money is part of your everyday routine. You don't just leave your house without your pocketbook. Guys, you don't leave without your wallet. It's part of your everyday routine. So it isn't very difficult to start thinking about, once our minds start to shift, how we see wealth building. That becomes part of our everyday process. The number two reason, legacy planning. The word planning, this is what I focus on. We focus on aligning your mindset about money with tools like life insurance and annuities to ensure long-term family wealth and legacy. Not immediate, but long-term. Number three reason, financial education. In this approach, it includes continuous learning. It's all about the financial opportunities and the risks that empower you when you make decisions. So when you're out and about and you're walking around, we want you making, the right decisions. We want you to hear my voice while you're out there, right? While you're out there to the world, we want you to be listening. That's important. Number four reason is diversification. See, by leveraging tools like life insurance and annuities, you're also getting the opportunity to grow passive income strategies. And then we can diversify from one portfolio to another, leveraging your retirement portfolio if we necessarily need to. Number five, community support. It's because of people like you. See, when you join our Lifestyle Focused Wealth community, man, I tell you, you start having these conversations with people and you start realizing not everybody has the answer. And then once you get into a group of people where you find everybody's already doing the same thing, guess what happens? You want to be a part of that community because it provides you access to resources, insights, and networking opportunities. Like finding that's what you need. It's a big family, big network. And we need that network. We need one another. I always say it, all you need is in the room. And guess what? When you put 5 or 6 people, trusted people at the top of their game in the room, making sound financial decisions in the room, guess what happens? Synergy happens. And everybody wants to be a part. And this is why the community support is so important. It's so important. Hey, when you hear the music coming on, that means it's almost our time to go. If you've had an opportunity to enjoy our show today, please do me a favor. Hit the like button, the thumbs up button, the actual thumbs up button. Hit that. Subscribe. Share with your family and friends, and come back next week and bring somebody with you. We'll be more than happy to answer questions. And don't forget, we got an opportunity for you to sit down one-on-one or bring your family and schedule some group time with us. I'd love to talk to you. If we can help you off camera, that's great. And if you want us to answer your question online, send me an email. It's very simple. info@roncojohnson.com. Hey, man, thanks again. It has been a pleasure talking to you. And I hope you have a wonderful and blessed holiday weekend and enjoying the family, looking for those eggs. I hope I gave you the money egg today to get you where you need to go. And I look forward to seeing you at the top next week, 1 o'clock on Friday, Lifestyle Focus Wealth, right here with your guy. I look forward to seeing you soon. Until then, so long. Have a great day.